let's discuss about the cost of capital. As you all know that the company will collect the funds from different parties and invest these funds into the projects and expecting a certain rate of return from the projects for giving the compensation to the suppliers of funds. This is the concept of cost of capital. So let's look into what's project's cost of capital. It's known as the minimum rate of return expected by the investor from the projects for giving the compensation to the suppliers of funds, which is completely depending on the riskiness of the cash flows of that project. That's known as project's cost of capital. Second one is firm's cost of capital. It is the minimum rate of return expected by the company from all projects for giving the compensation to the entire suppliers of funds. That's known as firm's cost of capital. So what's the difference between these two? Let's look into that. A company has certain rate of return expected from the projects alone for giving the compensation to the suppliers of funds. That's known as project's cost of capital. But the firm will expect certain rate of return from the aggregate projects for giving the compensation to the entire suppliers of funds. It's known as firm's cost of capital. So here, what you want to understand, firm will procure the funds from debenture holders, banks, financial institutions, preference shareholders, equity shareholders, and invest these funds into different projects. And firm must generate a minimum rate of return from all these projects for giving the compensation as benefits to the shareholders, preference shareholders, debenture holders, banks, and other financial institutions. So here everybody have their own expectations. Firm will expect a minimum rate of return from the projects. The suppliers of funds will expect a certain rate of return from the company as compensation. So the expected rate of return is basically known as the cost of capital. This expected rate of return is minimum in nature, then it's known as cost of capital. So basically the cost of capital is used for evaluating the investment decision. So if the project is acceptable or not, you can evaluate all types of acceptance rejection decision of the projects based on the concept of cost of capital. The second important decision is you can design a firm's debt policy, which means that how much debt and how much equity can be used in the capital structure of the company. It's completely based on the cost of capital. The third one is you can evaluate the financial performance of the top management based on how much reduction of cost of capital done by that management. So it's the ultimate objective of the management to reduce the cost of capital for maximizing the profitability. So you can evaluate the financial performance as well as the performance of the top level management with the help of cost of capital. So these are the three most important things which can be done with the help of cost of capital. You can accept the projects or reject the projects based on cost of capital. You can design a debt policy, how much debt and how much equity can be used in the capital structure can be taken with the help of cost of capital. You can evaluate the financial performance of the top level management also with the help of this concept. Let's look into this picture. The cost is associated with each and every investment item has been given here. Equity shares are on the top. What does it mean? The cost of equity is higher than all other investments. Then the second one is cost of preference shares. And third one is cost of corporate bonds. And fourth one is cost of government bonds. And last one is cost of risk-free securities. So what is risk-free securities? It's known as treasury bill. So without taking risk, you are investing into an asset and you expect a minimum rate of return from a risk-free security. That rate of return is known as a risk-free rate of return. That's on the loss. And what's the expected rate of return of equity? Equity's expected rate of return is much higher than all other investment assets. So you can easily understand the comparisons between the cost of equity, cost of debt, cost of preference shares, everything from this particular picture. So basically the cost of capital are of two types. The first one is known as weighted average cost of capital and second one is specific cost of capital. The overall cost of capital is known as weighted average cost of capital. In simple words, what's the minimum rate of return expected by the company from all projects for giving the compensation to the entire suppliers of funds? That's known as weighted average cost of capital. What is specific cost of capital? The cost of capital of each and every source of capital is known as specific cost of capital. What does it mean? It's known as equity shareholders supply the funds to the company and equity shareholders expect a minimum rate of return from the company as compensation. That cost of capital is known as cost of equity. Debenture holders supply the funds to the firm and they expect a minimum rate of return from the company as remuneration. That is known as cost of debt. Just like that, preference shareholders supply the funds to the firm and they expect a certain rate of return as minimum from the company. That is known as cost of preference shares. So the cost of capital of each and every source is basically known as the specific cost of capital. So two things are viewed from two angles. The specific cost of capital viewed from the suppliers of funds angles and weighted average cost of capital can be viewed from the company's point of view. So that's the difference between these two. And what's marginal cost? As you all know that additional cost that incurred in related to the investment decisions in the future cost is known as marginal cost. So let's look into the formula. What's cost of debt? First we will discuss about cost of debt. Debt, as you all know that debenture holders supply the funds to the firms. Banks and financial institutions supply the funds to the firms. That's known as debt. So banks have certain minimum rate of return expected from the company. That's known as cost of term loan. And debenture holders have certain minimum rate of return expectations from the company. That is known as cost of debt. As you all know that debentures are issued at face value and premium or discount. If the debentures are issued at par, that's known as face value. This is the formula for calculating the cost of debt. Let's look into that. Cost of debt equals interest divided by B0. So you can easily understand what will be the cost related to the cost of debt from this formula. And the debentures are issued at discount or premium. This is the formula interest divided by 1 plus KD plus B divided by 1 plus KD. So this KD is known as cost of debt, INT is known as interest, this B is known as redemption price. Finally, after 5 years, there will be a price for the debentures, that's known as redemption price. So as you all know that this is known as cost of debt at par value, cost of debt at premium, and cost of debt at discount. And the last one is cost of preference share capital. As you all know that preference share capital are known as hybrid securities, which shows the characteristics of equity shares and debentures. So let's look into two types of preference shares. One is known as irredeemable preference shares and second one is redeemable preference shares. So this is the formula for cost of irredeemable preference shares. Let's look into that. That is PDIV divided by P0. What does it mean? That's known as dividend divided by P0. And here dividend divided by 1 plus KP plus P divided by 1 plus KP. So these are the formulas associated with the cost of debt and cost of preference shares. When we work out the problems, you will understand what's the calculation part and all. Thank you. Thank you.